Welcome to the third and final video of our bookkeeping series, where we're covering exactly how to bookkeep for small business owners, step by step. I don't know if you're feeling what I'm feeling, but after 2 going on 3 bookkeeping videos together, I think we're officially BFFs. In our first 2 videos, we covered how to choose your bookkeeping method and set yourself up for bookkeeping success. So check them out if you haven't already. By the end of this video, you'll feel more confident about how to bookkeep and make the best bookkeeping decisions for your business. There are 5 key steps to managing your books, and you should tackle them all in the following order. Gather your financial documents, categorize your business transactions, reconcile your business transactions, prepare your financial statements, and finally, review your financial statements. Starting with step number 1. Once you've determined the right bookkeeping and corresponding accounting method, it's time to gather what is referred to as your business's source financial documents. A source financial document is the first documentation of a business transaction, which is a fancy way of referring to things like invoices and receipts. You'll use these documents as a reference throughout the bookkeeping process, and they need to contain information about the date of transaction, the buyer and the seller, the amount of the transaction, and the products or service provided. The key to easily accessing your source financial documents is to record, and record. You need to keep track of every sale and purchase you make, which is no small task. The beauty of accounting software like Wave is that you can connect it to your business bank account, import transactions, and automatically generate reports. This means you skip the hassle of manually recording each source of income and expense for your business, saving major time and reducing the risk of errors. Once you've gathered your business's source documents, you'll need to categorize them, which simply means sorting them into particular categories. If you're using accounting software, it will likely enable more efficient categorization, which is a major time saver. And to do any of the next steps right, it's important that you record and categorize every transaction correctly. There are 5 main categories a transaction can fall into when categorizing: assets, liabilities, equity, revenue, or expenses. Let's go over the definitions of each category. Assets refer to anything tangible and intangible that your company owns. This means physical assets like cash, equipment, and inventory, along with non-physical assets like intellectual property or patents. For example, if you own a landscaping company, your mower or other heavy equipment would be categorized as an asset. Anything you'll get long-term benefits from, like investing in a new computer for your business, also goes under assets. Next, liabilities refer to money that will leave your business and get paid to someone else at a future date. For example, if you take out a loan, you'll have to pay that back at some point. You may also have amounts owing on credit cards, funds that need to be paid to vendors, or payment terms on a vehicle or item of equipment you purchased. Now, any money or investments coming in from the owner of the business, likely you, goes under equity. This includes cash, as well as equipment and property. For example, if you invest your personal money into your business, that's you putting equity into the business. And likewise, if you pull money out of your business to, let's say, invest it somewhere else, that affects equity as well. The money you make from selling goods or services goes under revenue. This one is nice and simple. I mean, who doesn't love revenue? Any purchases you make or money you spend for the operation of your business goes under expenses. Think supplies, utilities, or advertising. Lastly, there's one situation you might run into that doesn't fit neatly into any category, and that's transfers. This happens when you transfer money from one of your business accounts to another or to a business credit card. Think of it this way: moving money from one account to another is like moving a $5 bill from one pocket to another. You're not getting richer or poorer, the money is simply in another place. Even so, you have to show that the money exited one account and entered another in your accounting record. This might look different depending on which accounting software you use, but it ensures you aren't duplicating any of your income or expenses. Next up, it's time to reconcile your business transactions. The term reconciliation might sound intense, but it just involves comparing your business books and/or your bookkeeping software to your bank statements to make sure the information matches and that every transaction is accounted for and hasn't been counted twice. It's like double-checking your work. So, how do you reconcile? Start by checking that the beginning balance shown in your business books and your bank statement is the same. If it is, you're on the right track. The beginning balance is the amount of money your business has at the beginning of an accounting period. Then check each transaction line by line. The more often you reconcile, the better. It will allow you to catch any overlooked transactions faster and save yourself a lot of headaches. We suggest doing it at least monthly. You can also hire a bookkeeping pro to walk you through exactly how to reconcile. Everything we've covered so far has been leading up to this next step. Now that your books are nice and balanced, we're going to use the information to prepare important financial documents, including a balance sheet, a profit and loss statement, and a cash flow statement. If you use Wave's accounting feature, these forms will be automatically generated for you using our reports feature. As long as you've done all the previous steps correctly, your reports will be accurate. If you want to learn more about reports specifically, check out the reports tour in the description below. The balance sheet contains information about your assets, liabilities, and equity for a given period, providing you a snapshot of your business's financial health based on what it owes and owns. Your assets are listed on the left side of the document. Cash is always listed first, followed by the rest of your assets based on how quickly each asset can be converted into cash. Liabilities are listed after on the right side. Then, add up your assets and liabilities, subtract your liabilities from your assets. The number you get is your equity. Your balance sheet needs to be, well, balanced. The assets should always be equal to your liabilities, plus equity. The profit and loss statement is sometimes referred to as an income statement. This report is great for two reasons. First, it helps you better understand what types of expenses and income are most impacting your bottom line. And second, it's one of the most important reports you or your tax professional will need at tax time. To prepare a profit and loss statement, first include all the revenue your business made during that period. Then add up all the expenses from that period. This includes the cost of goods sold, aka what it costs to make and sell your goods and services. Finally, subtract your total expenses from your total revenue to get your bottom line, also known as your net income. This is the profit you have left over after paying your expenses. Your cash flow statement helps bridge the gap between your balance sheet and your profit and loss statement by showing how money moved into and out of your business in a given period. It lets you know if your business is making money at a healthy pace or if you soon might be struggling to pay bills. There are three parts of a cash flow statement: cash from operations, cash from financing, and cash from investments. Cash flow from operating activities refers to the cash entering or leaving your business during its daily operations, like selling a product or paying a contractor. Cash flow from financing activities includes cash you've gained or lost from financing your business, including gains and losses from investors or loans. Cash flow from investing activities includes cash your business has earned or lost by investing in long-term assets like equipment. Now, it's time to analyze your financial documents in order to get key insights into your business's health. The assets section of your balance sheet tells you how much value your business has, while the liability section tells you how much money you owe. The equity section gives you the net worth of your business, which is the value of all your non-financial and financial assets. You can further analyze your balance sheet using financial ratios. For example, the current ratio is a formula used to determine if you'll be able to meet your financial obligations within the next year, and it's calculated by taking current assets and dividing by current liabilities. If your ratio is less than 1-to-1, that indicates you don't have enough assets or money to cover your liabilities or bills for this period. Your profit and loss statement shows you how much your business is earning and spending, and ultimately what the net profit is. You can use financial ratios here to dive deeper into your profit and loss statement. An example of a popular ratio is the gross profit margin, which is cost of goods sold subtracted from total revenue, divided by total revenue. It shows the income your business has remaining after paying off the cost of goods sold. What qualifies as a good gross profit margin is subjective, but generally anything over 25% is good news. Your cash flow statement helps you understand how money moves into and out of your business. You can further understand your cash flow statement using, yep, you guessed it, more financial ratios. Let's use the cash flow coverage ratio as an example. It tells if you have enough cash to pay off debts in the short term and the long term. To calculate the cash flow coverage ratio, divide net cash flow from operations by total debt. A good ratio is above 1.0. Of course, every business is unique, so before you get started, it's always best to speak with an accounting professional who can help you decide what's best for your business. That's it. We made it. You now know the basics of bookkeeping, how to create and read financial statements, and how to use the data to make smart money decisions. If you need something actionable to get started on right away, and if you haven't already, we recommend getting accounting software. Wave's accounting feature helps with most of the bookkeeping work. including generating financial reports, so you can spend more time running your business. You can also hire Wave's in-house bookkeeping experts to help you out with categorization, reconciliation, and bookkeeping in general, or have them do it for you in your Wave account. Visit the link in the description to learn how Wave can make your bookkeeping easier. Now, get out of here and show your books who's boss.